Right now, Bitfarms, ticker BITF, is trading live at $3.09, and it is getting absolutely hammered, down 8.32% on the day. The market just opened, and this is a reaction to the news that dropped just before the bell. Many investors look at this and see the usual. They think, oh, Bitcoin must be down, so the miner is down. That is the expectation. But that is not what is happening today. The reality is that this plunge is entirely self-inflicted. Bitfarms just reported its third quarter 2025 earnings, and it was a catastrophic miss on almost every single metric. The expectation was for a tightening of operations. The reality is a complete failure to meet consensus, coupled with a risky, complex strategic pivot that has the market spooked. This 8% drop isn't just crypto volatility, it's a fundamental crisis of confidence in the company's business model. Let's establish the common ground, the story that gets told on investing sites and in forums. The general belief is that stocks like Bitfarms are a simple, leveraged way to play the price of Bitcoin. You don't want to deal with digital wallets, so you open your Robinhood app or your SoFi Invest account and you buy a miner. You see it as a high-growth tech stock, a name you buy alongside your Tesla stock or your Nvidia stock, believing it's part of that same disruptive wave. The expectation is straightforward. Bitcoin goes up 10%, BITF goes up 30%. It's an easy path for self-investing enthusiasts to get exposure. But the reality, which is laid bare by today's financial report, is that you are not buying a proxy for Bitcoin. You are buying a highly capital-intensive, operationally complex, and brutally competitive industrial business. A business that has to manage massive energy costs, global logistics, relentless hardware upgrade cycles, and significant debt. Today's 8% collapse has almost nothing to do with Bitcoin's daily fluctuation and everything to do with the market realizing Bitfarms is struggling with the business of mining. Let's break down the numbers from this morning's Q3 report, because this is the entire story. The analyst consensus, what the smart money investment community expected, was a loss of about 2 cents per share. The reality, they posted a loss of 8 cents per share. That is a massive miss. Wall Street was looking for revenue of around $84.7 million. The reality, they delivered only $69.3 million. That is a $15 million shortfall. It gets worse. Analysts estimated they would mine 731 bitcoins in the quarter. They only mined 520. And perhaps the most terrifying metric of all, the one that active traders on platforms like Interactive Brokers are laser-focused on, their total cash cost per BTC. This is what it cost them, all in, to produce 1 Bitcoin. That number came in at a staggering $82,400. With Bitcoin's price hovering in the high 60,000s, that metric suggests their core business is fundamentally unprofitable at current levels. Their direct cost was $48,200, but the total cash cost shows the true bleed. This is the reality that shatters the simple Bitcoin proxy expectation. The market's reaction is not just to the bad quarter. It's a reaction to the company's new strategy, which was announced alongside these terrible numbers. Management is attempting to change the narrative. They are now pivoting, describing themselves as a North American energy and digital infrastructure company. They announced plans to convert their Washington mining site to support high-performance computing and AI workloads, specifically name-dropping support for NVIDIA's next-generation Vera Rubin GPUs. To fund this, they've discontinued operations in Argentina and Paraguay to focus on North America. This is a bet-the-company move. The expectation they want to set is that they are becoming an AI infrastructure play, just like the data centers that are in such high demand. The market's reality check, however, is that this is an incredibly expensive and difficult pivot, funded by a company whose core business is struggling. They are moving from one cutthroat industry, Bitcoin mining, into another, AI data centers that is dominated by giants. This isn't a simple online investment anymore. It's a complex turnaround story, and the market is signaling it doesn't buy it. This stock's recent movement has been a mess, reflecting this underlying tension. Even before today's earnings day crash, the stock has been volatile. We saw it drift down from its recent highs near $3.50 as investors got nervous heading into the report. The trading volume today is explosive, already multiples of its daily average just minutes into the session. This is institutional selling. This is automated SoFi trading algorithms hitting the sell based on the EPS miss. This is not retail panic, not yet. This is the smart money that perhaps used a sophisticated Fidelity trading platform to build a position and is now running for the exit. We also know from recent filings that Riot Platforms, which famously tried a hostile takeover of Bitfarms earlier this year and became its largest shareholder, has been selling down its stake. They recently dropped below the 10% ownership threshold. That's a massive vote of no confidence from its closest competitor. This is the kind of high-risk stock that is the absolute opposite of what Schwab Intelligent Portfolios or a broad Fidelity ETF is designed to do. Those are built for steady, diversified, long-term growth. Bitfarms is a binary bet on management's ability to execute a difficult pivot while their main business is underwater. It's a stock that many investors using SoFi active investing tools are drawn to for its lottery ticket-like upside. But today, they are feeling the full force of the downside. Even comparing it to other high-growth names is difficult. Apple stock has a fortress balance sheet and a massive high-margin services business. Tesla stock has diversified into energy storage. Bitfarms has a struggling mining operation and a plan to get into AI. For those who are newer to the story, Bitfarms has traditionally been a pure-play Bitcoin miner. They build and operate large data centers, primarily in Canada and the US after this new pivot. They fill these centers with thousands of specialized computers, ASICs, that run 24/7 to mine new Bitcoin. Their business model was supposed to be simple: mine Bitcoin for a cost, mostly energy, that is far lower than the market price of Bitcoin. Then either sell that Bitcoin to fund operations and expansion or hold it on their balance sheet, a hodl strategy, betting the price will go up. This model is fine in a bull market, but today's report shows that their costs are ballooning and their production is falling, even as they've raised significant capital through a $588 million convertible note offering and a dilutive at-the-market share program. They have liquidity, with $814 million available, but they are burning through it, and now they are committing that capital to a whole new industry. So what is the future outlook here? This is where the expectation versus reality framework is most critical. The bullish expectation, the story the company wants you to believe, is this: the pivot to AI and HPC is brilliant. They are front-running a massive demand for compute power, leveraging their expertise in building and managing high-density data centers. They will secure long-term contracts from AI companies, creating a stable, recurring revenue stream that is not tied to Bitcoin's volatility. Meanwhile, their remaining, optimized mining operations will benefit from any future Bitcoin price rally. In this world, the stock recovers and goes to new highs. This is the narrative that someone just getting investment help might be sold on. But the bearish reality is far more likely in the short term. The Q3 report is a 5-alarm fire. It signals that their core mining business is operationally broken. The pivot to AI is not a strategic choice, it's an act of desperation. They are now competing with Amazon AWS, Google Cloud, and dozens of specialized data center REITs, all of whom have more experience, deeper pockets, and better relationships. The $814 million in liquidity will be spent very quickly building out these new facilities, and there is no guarantee the customers will come. The Zacks analyst report, even before this miss, highlighted the company's negative return on capital as a massive red flag, and today's numbers just confirmed that. The stock is likely to remain under intense pressure. This is not a stock you park in your Fidelity IRAs and check in on in 10 years. This is a trading vehicle, and right now, the trade is violently to the downside. This brings up a serious question about the company's future. I want you to comment below with your thoughts on this. After this disastrous Q3 report, do you think Bitfarms' pivot to AI is a smart move, or is it a desperate last-ditch effort? Let me know what you think in the comments. This situation highlights the perils of online investing without understanding the business fundamentals. It's easy to buy Robinhood fractional shares of a company or even use a platform like Interactive